The US economy is definitely deteriorating and moving towards a recession. History is on the side of gold actually declining after you have a geopolitical event. Gold is the ultimate source of liquidity, and so when people need liquidity, gold is often the first thing that they sell because it can be sold. The oil price moving up potentially reduces the demand from some of the biggest nations buying gold. I think we're going to see 6,000 in 18 months.
6,000 gold in 18 months. And what would be the catalyst to get it there?
This is The Real Story with Michelle Makori.
Hello, I'm Michelle Makori. Thank you for joining us. Since the war in Iran began, gold has dropped 12%. Now, gold is the ultimate safe haven. So when war breaks out, when missiles fly, when the world feels unstable, the assumption is simple: gold should surge. And yet that is not what we've seen. Gold did rally pre the Iran war and then pulled back dramatically. And for many investors, that has been confusing. But according to my next guest, this move is not unusual at all. In fact, he says what we've seen in gold is actually very logical and very normal. Here to answer why and what to expect next from gold, oil, gold mining stocks, equities, and the Fed is Adrian Day, Chairman and CEO of Adrian Day Asset Management. He's also the editor of Adrian Day's Global Analyst, where he advises institutional and private investors on global markets, gold, and resource equities. And he is also the portfolio manager of the Euro-Pacific Gold Fund and the author of 4 books on international investing and natural resources, including Investing in Resources, How to Profit from the Outside Potential and Avoid the Risks. Adrian, very good to have you with us. Thanks for joining us.
Well, thank you very much for having me back. Good to see you again, Michelle.
All right, Adrian, you have made the point that gold does not always behave the way people expect during geopolitical events. So let's start right there, because many gold investors assumed that war is automatically bullish for gold. That's not what we've seen here. And you argue that history, in fact, shows that the opposite can often happen and does. So what do you make of this move lower in gold since the war in Iran began?
Yeah, no, that's a good question. I actually, because a lot of investors, and I've got comments all week in the last 2 weeks, why isn't gold moving? It's a war. Why isn't gold moving? And I actually did a study a couple of years ago on every geopolitical event and how you define them, of course. It's a bit subjective, but I looked at every geopolitical event, and then I looked at, for the last 45 years, and then I looked at gold reaction. And in fact, in a majority of those events, we're talking negative geopolitical events, not like the wall coming down, gold declined. So history is on the side of gold actually declining after you have a geopolitical event. You have to ask why. And I think there are some and it's not always the case. And if you want, we can talk about the cases where, in fact, gold goes up, because that's instructive as well. But most of the time, what you see, as you've just said, and that's the number one reason, is that gold moves up ahead of the geopolitical event. I won't say very rarely, but most of the time, these geopolitical events are not completely out of the blue. Sometimes they are. But normally they're not. The invasion of Iraq, for example, was well telegraphed. The invasion of Ukraine, well telegraphed. And the same with the bombing of Iran. For weeks, we had people saying, will they or won't they? Is it going to happen? Won't it happen? And so gold was moving up dramatically ahead. It was up $500 in 8 trading days. And so it moved up dramatically. And so it's a question of buy the rumor, sell the news. And we see that in a lot of markets all the time. When good news comes out and the stock falls, people say, why? Well, why? Because people were buying it in anticipation of the good news. But I think with gold and geopolitical events, there's a couple of other reasons. One reason is the dollar. If you just look at, could you show the slide, please? If you just look at what's been happening in the last month since the bombing, well, since the beginning of February, gold is the top line. You had the black line. You have gold move up in anticipation, and then you started to see the dollar which is the orange line, the bottom line, overtake it. And I think there's a reasonably clear inverse correlation between the dollar and gold. And not surprisingly, today the dollar fell sharply and gold moved up also sharply. So remember that the dollar is also a safe haven asset. And so when you have a geopolitical event, people also flock to the dollar. And in this particular case, not only did the dollar go up, as you can see on this graph, the dollar went up like a day before the bombing started, and gold dropped a day after the bombing started. It's almost to the day, but we had this switch. You also had yields go up. And so you had the dollar going up and yields on treasuries going up. And so the competition for gold became more important. I think the second important thing to realize, though, is that often in geopolitical events, there is a rush to liquidity, whether it's a global rush to liquidity like 2008, or whether it's a geographically confined rush to liquidity, such as with the Iran situation. But when you have a rush to liquidity, gold always revolves to the detriment of gold, because gold is the ultimate source of liquidity. It can be sold anywhere in the world 24 hours a day. And so when people need liquidity, gold is often the first thing that they sell, again, because it can be sold. And in this case, we saw it. We saw gold regionally in the Emirates and in Dubai. Gold was actually selling at a meaningful discount to the world price as people were dumping their gold. Well, why? I mean, if the missiles had just dropped on the Fairmont Hotel, and you want to get your family out, and there's no seat on the commercial airlines because there's no commercial airlines, and you have to pay an excessive price to get your family out, and you've got gold stuck in a vault, it's a natural thing to sell the gold and stick your family on a plane. So in a liquidity, so we had that liquidity issue as well. So all those things came together, Michelle.
All right. So your main point, though, it needs to be a geopolitical surprise event to see gold surge immediately. Otherwise, buy on the rumor, sell off on the news.
Absolutely.
I want to get into some of the other theories about what we saw gold do, but I do want to challenge, or rather clarify, what you mean by gold is the ultimate form of liquidity, because gold, highly liquid globally, it's not instantaneously liquid in the same way that digital financial assets are. You can't just press a button at 2 o'clock in the morning and convert physical gold into spendable dollars in your account. And obviously the liquidity depends on the form and context of what you're holding.
Sure.
If it is physical gold, like you mentioned in Dubai, you need a DLS settlement verification. Allocated gold depends on the custodian and the redemption terms. ETFs, yes, those you can trade during market hours, but that's not literally 24/7. Futures are liquid, but tied to exchange hours, margin mechanics. You do have tokenized gold, which is often presented as 24/7 liquid gold, and that's why that's getting a lot of traction. And yes, it is an asset that can be converted and settled without counterparty friction. But the idea that it's 24/7 liquid, isn't that something that needs to be challenged? I mean, it is globally recognized collateral. It's deeply liquid across jurisdictions, but it's not
Right.
always immediately transactional
Well, I guess
liquid on demand. So I guess
Yeah.
if you would distinguish between liquidity as an asset that you can ultimately convert anywhere in the world versus liquidity in something you can instantly sell.
No, of course, what you're saying is absolutely correct. I mean, I guess the point is gold is traded 24 hours a day, but my actual gold, if I want to sell it now, oh my gosh, it's 5:40 in Puerto Rico. I can't sell my physical gold. But on Monday morning, I can go and get it out of a bank and find someone who will buy it without any problem. And if it's 9 o'clock in the morning, I can do it the same day. But yeah, of course, you're absolutely right that I can't sell it immediately, depending on the time zone. But I think the other thing is people buy gold frequently. They buy gold precisely for this kind of event. They buy gold to use in an emergency. And so, again, that's natural when you have this kind of emergency to go to the asset that you bought for the emergency.
Right. And it's not just individuals that we see selling gold in emergencies. You've also seen central banks selling, like from Turkey, for example, which was potentially significant here because Turkey's central bank sold or swapped roughly 60 tons of gold. That's around 8 billion, more or less, just 2 weeks after the war began. And Turkey had been one of the most aggressive gold buyers over the past decade. But why sell now? The question is to defend the lira, get access, need for dollars in a time of war in order to purchase oil, to purchase energy. That's one of the factors. Then, of course, selling by a central bank in order to have access to other commodities or resources in a time of conflict would make sense as well, why we saw that sell-off. So make that connection between times of crisis, higher oil prices, and gold.
Yeah, well, what you're saying about the central bank selling, I think, is very significant. It's significant in two ways. It's not, as you know, it's not just Turkey. Poland has also sold some gold. Now, they did a swap, so they bought longer-term calls so they can buy it back. But the point is the physical gold was actually sold into the market, which is what we're talking about here. We're not concerned with whether Poland is retaining its exposure to gold. We're concerned with what actually happened in the market with physical gold. Russia also sold some. And so, and in the case of Turkey, as you say, nearly 60 tons. I mean, that's meaningful. Last year, I think all central banks bought about 860 tons. So 60 tons out of 860 for all central banks is a pretty meaningful impact. I think that the announcement that Turkey had sold, which initially got a lot of commentary from people saying, oh, this is awful, the central banks are going to start selling. In fact, that's the day gold bottomed and started moving up. And again, it's not illogical because when we suddenly realized, wow, one of the major reasons that gold fell in the first 2 weeks of March was because Turkey was selling 60 tons, then we know what the reason is. And we can assess to some degree or another whether they're likely to continue selling. But at least we know what the reason gold fell was, or one of the reasons that gold fell. So, I mean, I think it's positive that the market knew. It's not positive that Turkey sold, but having sold, it becomes a positive that we know why they sold. And
Well,
of course, sorry.
go ahead.
Well, I was just going to say, it's not just the physical buying and selling of gold and the war. There's also the monetary aspects as well, but that have an economic aspects that have a big impact. With gold moving up so dramatically, with oil moving up so dramatically, that really potentially hurts, and actually hurts some of the largest gold buying nations in the world. India, China, both heavy oil importers. So as the oil price moves up, that hurts their economy, both on the national, the national scale, but also on an individual basis. So people don't have as much money left to buy gold. And both India and China, as you know, have been some of the biggest buyers, both public sector, but also the private sector for buying gold. So the oil price moving up potentially reduces the demand from some of the biggest nations buying gold. It also, of course, has a general dampening effect on the economy around the world, even the U.S. economy, or North American, let's say, where the U.S. today, Canada's always had a lot of oil, but the U.S. today is much less dependent on foreign oil than it was, say, in the 1974 oil embargo, where the oil embargo just had an immediate and very dramatic effect on the U.S. economy, the worst recession since the 1930s, but also on the price of gold. I was about to say, do you remember? Of course you don't remember, but I remember, the price of gold fell virtually 50%. During the oil embargo. Now, this time it'll have a damaging, if it carries on this way, it'll have a very damaging effect, an equally damaging effect on the global economy, but I think less so on the U.S. economy because we're now not so dependent on Mideast oil. But nonetheless, if the world goes into a recession, you know, that also hurts the US. And if we're in a recession, again, that's going to be negative for gold buying.
Right. I do want to get to your thoughts on oil and the economy, but I want to just have you address one of the more controversial, shall we say, conspiracy theories with regards to gold going down. And that is that gold acts as a barometer of confidence in fiat currencies, particularly the dollar, and that there may be incentives, especially during periods of geopolitical stress or war, to keep that signal from flashing too brightly. You want a stronger dollar if you're at war. And, that does tie into a concept that many people forget exists, and that is what is known as the Plunge Protection Team, the President's Working Group on Financial Markets, which was created in 1988 to help coordinate market stability during periods of extreme volatility. So, when people say, look, we know that there's something known as the Plunge Protection Team, which is blatantly out there to prop up / manipulate markets, people are saying, if we're simply seeing normal market dynamics, or could there be some form of intervention through futures markets, broader liquidity operations that helps keep gold from reflecting dollar stress more clearly, that helps suppress the price of gold in order to bolster the dollar at a time of geopolitical conflict? What say you, Adrian Day?
Yeah. Well, look, I'm not, how can I put this? I sort of apply Occam's razor to investing and to geopolitical events. The simplest explanation to me is, if I can see a simple explanation, I don't have to look for conspiracies. And so if you look at where we are right now, and then let's compare it with 1979, which was another Iran crisis. They seem to be good at creating crises, that country. But think back to 1979, and that was the first major crisis on the study that I was talking about that I did. In 1979, you had the U.S. embassy taken over, U.S. people taken hostage, and you also had, let's not forget, a very, very dramatic and unfortunate failed rescue mission, remember? Which was on television for the whole world to see. But the U.S. tried to rescue these people from Iran of all places, and couldn't manage it. And at the same time, Russia marched into Afghanistan, and at the beginning, that went well. I say all that to set the scene. And so the perception at that time was that the U.S. is losing its power, losing its military dominance. And what happened? The dollar fell, and the dollar fell sharply. This time, you've had, I think it's fair to say that perhaps the war hasn't gone as quickly or as well and as quickly as Trump was expecting. That seems to be the case. But so far, it's hardly been a disaster for the U.S. and Israel. It's hardly been a disaster. And the U.S. is clearly exhibiting its power, and other countries are basically helpless. So the dollar has gone up because the U.S. is exhibiting its dominance and its power. So,
Right.
yeah, so I don't think you need to say, oh, well, that the Fed's buying gold, selling gold because they want the dollar to go up. You don't need to say that. I think it's happening for logical reasons.
Seeing as you brought up the idea of the United States flexing its military might here, which is exactly what got the dollar the reserve currency status in the first place, after helping the Allies win the war in World War II and the Bretton Woods system, you could make the point that a lot of this conflict was essentially about flexing that muscle, also reinstating the petrodollar, the idea that oil must be priced in dollars, and that in exchange for that, the U.S. guarantees security for countries around the world, as it did when it cut that deal with Saudi Arabia. And then that money that is needed to purchase oil in dollars, that those dollars are then recycled back into the U.S. economy and to buy dollar-denominated assets. I mean, there's a whole theory that one of the subtexts of this conflict is, in fact, to limit China's access to the steeply discounted oil from Iran, similarly as was done by exerting control over Venezuela. Now, this could go both ways. If this war is successful, then there is the argument that's made that this could be strengthening for the dollar and potentially not so well delays the idea of gold re-entering the global monetary system. The other argument is that if this conflict does not go well, then this weakens the dollar. And then you've got the third idea is that irrespective, this is fracturing the global system as we know it because it's creating more strife and more friction with countries, and they're less and less likely to trust the United States here. Very early to say how this conflict is resolved on the military side. Again, it depends which news media you listen to. Some say this war is going fantastically well, ahead of schedule. Some say it's not going well. It really depends on your sources. I'm not going to speculate on that. But assuming we get one resolution or the other, and assuming it is what is deemed to be a relatively positive resolution, what's your take on what that means for the dollar in terms of the de-dollarization trend and what it means for gold, which has been positioned as the neutral reserve asset stepping in to sort of replace the dollar in many ways?
Yeah, no, you've raised some really excellent questions there that I don't think are getting enough attention. I mean, I'm not a geopolitical or military analyst, so like you, I'm not going to speculate on what I think is going to happen because, I don't have an informed opinion or more informed than anyone else. But I can look at risks and potentialities and the impact on markets. You mentioned one very important thing, though, there that I will comment on, and that is the petrodollar and Saudi Arabia and so on. Iran, in my view, made a very, very, very significant and unnecessary and stupid mistake in sending missiles into their Arab nations. Iran, of course, is Persian, not Arab, and that was really unnecessary, but it was also stupid because at the beginning of this campaign, you remember well, a lot of the Arab countries, the Emirates and Saudi Arabia in particular, were very, very vocal in saying that they condemned the Israeli and US attacks on Iran. Iran turned around and started bombing those Arab countries. And those countries now, the Emirates, the Gulf Emirates, but in addition, Saudi Arabia, are now supporting the US verbally and talking about supporting militarily. And so this rupture in the US-Saudi oil program may actually be undone by this, and the Saudis become more friendly and more dependent on the US as they were, 5 years and 10 years ago. So, but to the broader question of the dollar, yeah, I mean, an awful lot to me does depend on how this war ends. If it ends in a disaster for the US, I think it'll just simply accelerate the move that we've seen away from the dollar. Because for the reasons we said about the first Iran, or not the first, the first Iran crisis in 1979, the perception will be that the US is losing its military dominance, and with military dominance, you lose your economic, and you lose your political and your economic dominance. But if in fact it goes very well from the US point of view, I think you said one word, which is delay. And I think all that would do, in my view, is delay what has been happening for 25 years and is almost inevitable. Inevitable doesn't mean imminent, but it's almost inevitable. And that means the decline of the US as the world's sole reserve currency. So it would delay it, there's no question, but I don't think it would change it or reverse course, because the reasons that the dollar has... Remember, central banks in 2000, at the beginning of this century and millennium, but in the year 2000, central banks on average, in aggregate, had 78% of their foreign reserves in the dollar. 78%. 5 years ago, that was down to 65%. So this decline in the, and now it's at around 48%. The decline in the dollar in central bank reserves has been long-standing. It started well before Trump was inaugurated a year ago. It's nothing to do with, the chaos and uncertainty that we've seen over the last 15 months. It's a long-standing thing. And the reasons the central banks have been selling, we all know what they are. They don't like concentration in a single asset, the asset of a fiscally profligate government, and a government that is willing to weaponize its dominance. Now, if the U.S. wins this war, has any of that changed? It would in fact only it would emphasize the view that the U.S. is willing to throw its power around. And if we see these comments about, Spain and other countries that don't allow us to use their bases or fly over their territory, well, hey, you didn't support us, we're not going to support you. That only reinforces the idea that the U.S. is willing to weaponize its dominance. So I don't think anything changes in the move away from the dollar. It might just delay it, as you say.
But could it accelerate it dramatically?
If the U.S. loses, I think it could accelerate.
Well, I don't think there'll be a scenario that will be framed as the U.S. losing anyway. I mean, and arguably a lot of the objectives, to be fair, have been achieved in terms of significantly decimating nuclear capabilities, missile firing capabilities, the decapitating the majority of the regime. Whether regime change is going to be successful or not seems to be determined. There's obviously, and this is such a fast-changing story, Adrian, by the time we put this out, which is usually within 24 hours, there could be a development, but we are also now seeing the idea of the Strait of Hormuz as an objective sort of being no longer something that the Secretary of War, Pete Hegseth, says needs to be a criteria for the United States, and something that, President Trump has been posting on Truth Social recently, saying that, and to your point, the U.S. has its own source of oil. The president posting all of those countries that can't get jet fuel because of the Strait of Hormuz, like the United Kingdom, which refused to get involved in the decapitation of Iran. I have a suggestion for you. Number one, buy from the U.S. We have plenty. And number two, build up some delayed courage, go to the Strait and just take it. You'll have to start learning how to fight for yourself. The U.S. won't be there to help you anymore, just like you weren't there for us. Iran has been essentially decimated. The hard part is done. Go get your own oil, President Donald J. Trump. So we're seeing growing tension between the U.S. and its traditional allies, particularly around NATO, particularly with their reluctance to help step in here. So even if this war is resolved favorably, how do you see that tension playing out with regards to the dollar and with regards to gold?
No, absolutely. If, and we talked about this privately before or yesterday, but no question, if that kind of, commentary, those kind of posts from Trump continue, that's got to make countries think, oh my gosh, I thought we were on friendly terms, but we better sell a few more dollars. No question about that. It will just accelerate the move out of the dollar. And let's not forget a very important point. I mentioned that central bank foreign reserves have gone from 78% in 2000 down to about 48% today. That's even as all of these countries were continuing to earn more dollars. So this has been a very, very dramatic reduction in the amount of dollars that countries are willing to hold, because they've been earning more dollars along the way, which means their selling has just had to accelerate. But I think you're absolutely right. I mean, and I'm not getting into the political side of it, but if President Trump makes comments like that, and he's targeted United Kingdom because he's really tired of Starmer, and I don't blame him. But that was a political comment. Sorry. But if he starts targeting specific countries verbally, those countries have got to start saying, do we really want to hold the dollar?
Look, the president targeting particular countries or companies for that matter verbally is nothing new. And again, I'm not saying that I'm not saying that I'm right. I don't have a position. I'm saying it could either significantly delay what many believe was inevitable anyway. It could just continue to kick the can down the road, or it could accelerate this process. And I think a lot of it depends on the outcome
On
of
the
this
outcome
conflict.
and the verbiage that we hear afterwards. But I can't see a scenario where Trump says, well, we won the war. I know you didn't help us, but hey, let's kiss and make up and we'll support you. Don't worry about it, guys.
Right.
That's what the House do.
And that's been a dynamic since before this war, the president asking NATO countries to pay their fair share to the NATO defense budget, as is outlined in their agreement. So it's just a continuation of a theme. I will point out, though, that we are seeing central banks selling treasuries. Same reason that they're selling gold, though, and that's to raise cash. Holdings at the Federal Reserve Bank of New York have dropped to their lowest level since 2012. Turkey, India, Thailand, they're the ones selling according to the latest data. And it's primarily countries that are under pressure from those rising energy costs.
Exactly.
So I want to bring it back to oil and the relationship between oil and gold here, Adrian, and particularly as it applies to the miners, because you've written extensively about that and what that means for mining equities as we're seeing gold prices drop a little bit at the same time as oil and energy prices are increasing for the gold miners. Break down what you've analyzed on that front for us.
Yeah, okay, I will. But again, I'm a historian by training, so I always go first of all to history, if you'll excuse me.
Please do.
You know, if we go back to the mid 2000, what do we call them? 2000 to 2010 period. You know, from 2006 to 2008, when the price of gold doubled, the margins actually did not increase at all because the costs went up by the same amount, and particularly the price of oil. Same thing happened 2010-11. Remember, 2011, the price of oil was $144 a barrel. So to set the scene, we entered this year in the most incredible period possible for mining companies, where the price of gold had more than doubled in 18 months, but the price of oil and their costs were still relatively flat. And so you had this enormous margin expansion in the gold mining companies. So that sets the scene. And so where we are now, if the price of oil stays over 100, yes, it's going to have a negative effect on costs for mining companies, no question about that. But given where we're starting from, given where the gold price is and where the gold prices come from and where the oil price is and where that's come from, and it's not just the oil price, of course, it's also what we call the commodity currencies, which are a large cost input because everything local, if you're a Canadian company with an Australian mine, the value of the Australian dollar is critical because everything you buy locally is either more or less expensive, depending on the value of the Australian dollar. Remember, the Australian dollar, the Canadian dollar were trading at premiums back in 2011. They're both trading at 30% discounts right now. You look at all the commodity currencies, South African rand, Chilean peso, they're pretty much all trading at weak prices. So the cost picture is extremely attractive for mining companies. That's where we're starting from. Now, a study from BMO, Bank of Montreal, said that on average, for every $10 increase in the price of oil, it adds $2 to the overall cost, the all-in sustaining costs of a gold mining company. Now, it's more in some regions, it's less in others. It's less in North America and Africa than it is in Latin America and Asia and Europe. But on average, it's about $2 for every $10. It also varies whether it's an an open pit mine or an underground mine. You know, so different mines will have different cost structures, but that's the average. So if oil goes from $60 to $100 and stays there, well, that's 9% increase, 9% increase in the cost of oil. That's meaningful, but it's not devastation. If you're Agnico Eagle and the price of gold is $4,500 and your all-in sustaining costs are $1,327, you can afford those prices to go up by 9%, without it really, I mean, it hurts your margins, but you've still got exceptionally attractive margins, right? And so, yes, it would be a negative, but starting where we're starting from, it would not be devastating. Now, of course, if the price of gold went to 100, 120, 140 and stayed there, then we're not talking not just about the cost of energy and diesel, because that starts to flow into all of your costs, right? And all of your costs go up. Consumer prices go up, so your workers want higher wages. It just flows into your food goes up because it has to be transported from somewhere, right? Your construction goes up because the energy to make the steel goes up, etc. But that's if the price of oil stays over $100. It'll have that impact subsequently. The other thing I think that's important to note is that many of the bigger and better companies have hedged their diesel. So you look at Agnico has hedged over half of its diesel for this year at $49 a liter. That's
Okay.
what, a fifth of the current price. I haven't looked at the current price today, sorry. But, it's a fraction of the current price. So it's only if the price moves up and stays up on a long-term period, a long-term horizon, that it begins to have a meaningful impact on the market.
But that, I'm looking at the VanEck Gold Miners ETF, GDX, and miners have sold up very sharply since the war began. They're currently down more than 20% since the war began.
Well, yeah, but that's because they had the leverage to gold, right? So gold miners do have leverage to gold. So when the price of gold falls, the gold miners are going to fall as well.
So you expect
at-
a
Sorry?
rebound. So you expect a rebound in the miners the minute we start to see gold continue to move up.
Yeah, absolutely. And I mean, it's worth, let me see if I can find it quickly. Yeah, if you show the graph that I've got up now, if you don't mind, this is Agnico Eagle's price to free cash flow going all the way back to, the last 5 years. So despite the huge run-up that we had in the price of Agnico Eagle, the huge run-up that we had in that price over the last 3 years, it is today trading at pretty much its lowest level, its lowest price to free cash flow, other than the depths of COVID. So the stocks are not expensive. And they're not expensive because even though the prices of the stocks have moved up, their cash flows, because of the margins, the cash flows have moved up even faster.
So are you seeing an opportunity in picking up some gold mining companies at this point? Or do you anticipate a further decline in equity markets overall, which would maybe or maybe not take down gold miners with it?
Well, yesterday, yes. Even this morning at 9:30, yes.
Fair enough.
At 4 o'clock, maybe not quite so much. No, but to be serious, yes. I think that the gold mining companies are still on a historic basis, as you can see from that graph. They are still undervalued relative to their own history, right? And if you look at good quality companies like Agnico or Royal Gold or Franco, yes, I would buy those if I didn't own them. You're seeing better values right now, I think, among the smaller companies, the intermediates, like Equinox, B2 Gold, and even the smaller ones. You're seeing better value. But no, I definitely think that that this is a good time to be buying the gold stocks because we've had that decline you talked about. But the sentiment towards gold and the price action of gold is improving. And they're still undervalued. So there's 3 reasons there to be looking at the gold stocks. I think how much to buy sort of depends on the individual. If you're a 75-year-old person with 50% of your net worth in gold mining companies, maybe you don't increase at this point. But boy, if you're new to the space, I would do at least 50% of my allocation right now. At least 50% of my allocation.
At least 50% of the allocation to gold
I don't mean
mining equities.
Sorry. If I'm not invested to gold, I would take my gold allocation, which might be 20% of my portfolio, And I would buy at least 50% of my allocation right now.
Okay. No, fair enough. That's why we clarified that. Now, granted, Adrian, as you said earlier this morning, markets behave differently to how they close, and a lot of it depends on the narrative with the conflict of Iran and likely resolution there. So it's very hard because that's a very fast-moving, constantly changing narrative there. But what is your outlook on equity markets at large? Because we've had some guests on the show that say, irrespective of how the Iran war works out, the fundamentals of the economy are not strong for various reasons. Private credit, AI bubbles, the Fed, irrespective, stuck between a rock and a hard place. What is and I get that this changes dramatically with how the war plays out, but what is your outlook, broadly speaking, on where we are with regards to the macroeconomic picture and the health of the US economy, and therefore the equity markets?
Right. Well, I think the U.S. economy is definitely deteriorating and moving towards a recession. As you said, the Fed is between a rock and a hard place with a slowing economy, a weakening employment picture, which is far worse than the headline numbers of unemployment would suggest. And new job creation. Because as you know, most of the new jobs, literally, most of the new jobs that were created last year were either government jobs or part-time jobs. That's not a healthy jobs market when people cannot find private sector full-time employment. And, we don't need to go too far into there. We can if you want. But so I think the economy slowing is particularly slowing for people at, let's say, the lower half in terms of assets and income, because when we've got stubborn inflation. That's the important thing to realize. We've got inflation that is more than 50% above the Fed's own arbitrary target. We've got inflation today that is higher than it was pre-COVID, for the 5 years prior to COVID. We can only have this narrative about inflation coming down because it spiked during the COVID shutdowns. But remember that we're talking about a rate of inflation. And so if inflation now is whatever the latest number was, 3.6%, depending on whether you're looking at PCE or, CPI or whatever, what you look, or the core or whatever. But, if you're looking at something between 3.5% and 4%, that's 3.5% on top of last year's 4%, on top of, 2000's 9.2%. So in the last 5 years, according to the government's own numbers, the consumer price index has gone up about 24%. And wages have not gone up 24%. So the typical worker has been falling behind. And when the Fed has easy money policies, as they have done for the last 15 years, and ramped it up during COVID, but we've had easy money policies basically for that entire period. If that money flows first of all to the big money center banks, then what it does is it juices asset prices as well as increase consumer prices. If you're in the top 1% or 2% or 10% and you've got a bunch of assets, well, you don't like prices going up, but it's not that meaningful to you. And you've got assets going up, to help. If you're in the bottom 50% where you really don't have any assets, you don't get the benefit of asset prices going up. You only get the detriment of prices going up. This is not a free market fault. This is a Federal Reserve. I lay the blame right at the Federal Reserve's door for having loose money policies, and the way that they've distributed that money into the system. So anyway, I think that the bottom half of the economy is already hurting, and we're heading is slowly, inexorably declining. And that means that the market is probably going to be weaker. I mean, we've had a bad March, obviously, but until the war started, the U.S. market was, in my view, just extremely overvalued. And we should remember that it's been the big tech, U.S. big tech, that has driven not only the S&P, but it has basically it's been the leader of markets around the world. I don't know if you want to pull up the graph that I've got, the table that I've got. This shows valuations. I'm a value investor, so I always start by looking at values. But this is very clear. You know, if for 15 years now, until last year, for 15 years, the US market has outperformed foreign markets. That's the world ex-US. It has outperformed for 15 years in a row until last year. That's a long period of time for the US to outperform. And if you go back 80 years, it's basically 50-50, whether the US outperforming foreign or foreign is outperforming US. So we've had this long period of outperformance by the US. These periods of outperformance and underperformance tend to be long periods. The period before the 15 years I'm talking about was an 8-year period when foreign markets outperformed the US. So last year, for the first time in 15 years, foreign markets outperformed the US. And they did it dramatically. The Morgan Stanley Capital International World ex-US Index was up about 32% last year. The S&P was up 18%, so 17%. So basically double. We're seeing it again this year. Even though the markets, a lot of the markets are down, I'm talking about relative performance here. So there's only two major markets, in fact. That's France and Germany, that have underperformed the US market this year. Every other market has outperformed. Even if they're down themselves, they've still outperformed the US. And if you look at it, so I think that the shift has come, and we're now going to see a period, it might be 5 years, it might be 7 years, but a period when the foreign markets outperform the US. And if you look at this table, you see the foreign markets are dramatically, these are some of my favorite markets that I put up. I didn't put the UK up. Why didn't I put the UK up? Sorry, because the UK is also one of my favorite markets, notwithstanding what's happening in that economy. But if you look at these basic fundamental metrics, the US is much more expensive than most of these other countries. So I think the shift has turned, but you're also able to get good quality companies at pretty attractive prices in many of these foreign countries.
So that's the opportunity that you're seeing right now. If you're deploying capital into equities, it would be foreign, non-US equity markets?
No, absolutely. I think you're also seeing a similar shift happening, but to a lesser degree, but a similar shift in growth versus value. If you go back to US versus foreign, last year was the widest gap ever in history between the US and foreign markets, the widest ever. In terms of value versus growth, there was like a 10-year low. And so what we saw last year, what we saw for the last 10 years is growth dramatically outperformed value. And that in itself is also unusual because if you go back 100 years, value has actually tended to outperform growth. But for the last 10 years, growth outperformed value. But last year, we started to see that shift, and we're seeing that same shift again this year. So basically what I'm saying is that I would look to get out of primarily the big US tech, and including AI. That would be the first thing I'll get out of. The smaller tech as well, but the things that have led in the US market, I would move out of. I would move into defensive stocks, into value stocks, into things that have lagged, like commodities, and I would move into foreign markets, which, as I say, are at 100-year lows relative to the US market.
All right, I do want to bring it back to the broader picture with regards to the US, and that's with all of this focus on the war, there's another number that's been exploding in the background, and that is US national debt, which has now surged past $39 trillion, happening just weeks into the conflict with Iran. At the pace we're going, we could hit 40 trillion before the end of the year. Again, a trend that was well in place before the Trump administration, but accelerating, and certainly accelerating with more defense spending. And we heard from Fed Chair Jerome Powell this week addressing this, saying that the path is unsustainable and that if nothing changes here, this will not end well. Let's play that clip.
What's clear is that our debt is growing much faster. The federal government debt is growing substantially faster than our economy, and that ratio is going up. And, in the long run, that's kind of the definition of unsustainable. The level of the debt is not unsustainable, but the path is not sustainable. And so it's really important that we get back to, we don't have to pay the debt down, we just need to have primary balance and begin to have the economy actually growing better, growing more quickly than the economy. It will not end well if we don't do something fairly soon. This is not the Fed's job, of course, and I pretty much limit myself to those high-level points which essentially everyone ignores.
When Powell says it will not end well, what does that mean? What does that look like? And if this is all hinging really on GDP growth, do you see that happening? Because others have made the argument that if you keep the GDP to debt ratio relatively balanced, then you can delay paying off that debt. But what are the options here, and what does it will not end well mean?
Yeah, well, first of all, I think hoping that growth will somehow magically get us out of the debt problem is wishful thinking. Yes, better growth and better productivity would help, but that's not good. Bad alone is we've gone too far in the US. They've gone too far for growth alone to get us out. So not how does it ending badly? What does that mean? Well, if you've got too much debt, you have to extinguish that debt, and you extinguish it either by default. I don't think the U.S. is going to ostensibly default, or you extinguish it or reduce it by inflation, and that is the most probable course. Or you can, of course, extinguish it. Some people think you can extinguish it by raising taxes to balance the budget. But the truth is that debt is so large that you could not raise enough. You cannot raise enough from income taxes to pay off the debt. And of course, increasing taxes, as we know, just reduces your economic growth. So that doesn't do any good. So in all probability, the US is going to extinguish or reduce its debt burden through inflation. The Treasury under Scott Bessent, is trying all the normal accounting tricks that everyone uses, but he's also trying, well, I won't call them gimmicks, but he's trying different things to try to increase the demand, like the Genius Act, to get to enable more US dollar crypto coins, but hopefully will increase the demand around the world. And that's all good. But it's all marginal. So you add all these things up and they're all marginal. They all help. But at the end of the day, it seems to me that the U.S. is simply going to have to, the U.S. is going to, not it has to, but is going to ease its burden by increasing inflation. Again, there's other things you can do, and the Trump administration has tried it. You can kind of tell your allies, hey, you want to be our friends, you better buy more treasury bills. But that's not having a huge positive impact, and it has an equally negative impact on people who don't see themselves as the U.S. friends. Mm-hmm. The other thing I will say that's really important on this, and remember, as the world's reserve currency, it was a French prime minister, was it Giscard d'Estaing, who called it an exorbitant privilege. It's a privilege because it enables you to print more money, and I use print, in the popular sense. It enables you to print more money than your economy needs because other countries will buy your treasuries, right? That's been the story ever since the end of the Second World War, and particularly since the end of Bretton Woods in 1971. The U.S. will have a much looser policy than is justified by the growth in this economy, but other people will absorb the shock, and we are in effect, and the deficit, particularly the trade deficit, becomes less important because we can export our inflation to other countries. That gain ends when you lose your reserve status. And we saw that very, very clearly, again, if we want a historic parallel, when at the end of the Second World War, when Britain came out of the Second World War victorious but broke, lost its reserve currency, And look what happened to both the state of Britain, the economy, and also the pound. It went from 5-1 against the dollar to 1-1 against the dollar. When you lose your reserve currency and people don't want your currency anymore. And, to the extent that the U.S. loses its sole reserve currency status, then the same thing's going to happen to the U.S. People don't want the dollar anymore. And it's not just public sector, it's private sector as well. I mean, to use a anecdote, I mean, you can go to any country in the world. You can go to Romania and say to a taxi driver, "Oh, I don't have my loo with me, but will you take $1?" They'll take the dollar. Or you can go to Brazil, to Colombia and buy drugs. "Oh, sorry, I don't have with me, but will you take dollars?" Anyone around the world, everyone around the world will accept a US dollar. And what do they do? What does that drug dealer do? At the end of the day, he has a stack of dollars and a stack of pesos. He saves the dollar and spends the pesos. So people are saving those dollars. When the dollar loses that reserve status and that sort of magical, perception of value, then all those dollars that people have in bank accounts, under the mattress, etc., they all start to flow back. And that just adds to inflation.
And that brings us back to gold.
Yes.
Because that's where gold would then come in and be that store of value, retaining purchasing power against dollar debasement and devaluation. So, Adrian, again, a lot of this depends on the war, and I get that. But I mean, I'm interested in your forecast for gold for the end of the year.
You want a price? Or can I just say,
The high bond price.
Well, you know what they say, don't you, Michelle? Never give a price and a date. If you're going to predict, just give one or the other.
Well, I'll tell you what. I'll help you out. Goldman Sachs says $5,400 an ounce by the end of the year. Agree or disagree?
I would think that is a rational but cautious, a cautious possibility. I think after the war ends or settles down or whatever, and the monetary factors and the factors we've been talking about, the fiscal factors come to the fore again, I think gold will easily exceed its current all-time high. But it's been delayed. So if you said to me, "Hey, Adrian, not at the end of this year, but I'll give you 18 months,
Sure.
I think we're going to see 6,000 in 18 months.
6,000 gold in 18 months. And
Yes.
what would be the catalyst to get it there?
Well, the war has to end, and the nervousness about the strength in the dollar and the nervousness about gold and liquidity and, places selling gold to support currencies and so on, that all has to end. But once that's end, I think the impetus is just the things that have been driving gold for the last 20 years and the last 3 years. That is people simply not trusting fiat currencies and wanting to move into an asset that is no one else's liability. And gold's the only asset that's nobody else's liability.
Right. So 6,000 in 18 months, more or less. I want to, because I love to hold you to targets, Adrian.
I know you do.
I do want to point out another topic that hasn't been getting a lot of attention with regards to inflation, because everyone is really focused on oil moving through the Strait of Hormuz. But there's another critical layer here that markets may be underestimating, and that is fertilizer. Roughly 1/3 of global seaborne fertilizer trade moves through the Strait of Hormuz, estimates ranging from 20% to around 30% of global fertilizer flows, even higher for key inputs like urea and ammonia. The Gulf region, in fact, supplies nearly half of global urea exports and about 30% of ammonia, both essential for modern agriculture. So this isn't just about energy inflation. It's also about the inputs that determine global food production and inflation there. So given that a meaningful chunk of the world's fertilizer supply flows through the Strait of Hormuz, we're already seeing price spikes tied to disruption. How do you see that playing out for global food inflation over the next 6 to 12 months? And more importantly, what are the opportunities here?
Well, no, that's a very important point. And again, it gets back to what we were talking about earlier, you don't have to be a geopolitical analyst and assess how things are going to end, but you can look at what the risks are. And I think there are just enormous risks. If this war continues and the Iranian Guard goes scorched earth, and they're talking of threatening to bomb the desalination plants. So it's more than just fertilizer
The
moving.
theory, yeah.
It's that whole region depends on desalination plants. So the risks, I think, are very, very serious, and particularly with fertilizer right now. You've got Australia has 2 growing seasons. You've got the planting seasons. You've got the second planting season right now in the northern hemisphere. Of course, you've got the annual planting season right now. So this is affecting plantings right now. So it's going to have an impact on food that's produced in 6 months' time. There's no question about that. Now, in North America, of course, Canada has an awful lot of potash. So, Canada and hopefully the US will not be as affected as many other countries in the world. But this could be absolutely devastating for some countries. No question about that. And of course, without the fertilizer, the crop yields are going to be smaller. We know that. And could be devastating. I'd like a little bit of a longer segue before we go from people starving to opportunities, if you don't mind.
Fair enough. I don't mean to be callous, but I think
No, but you did
oil.
ask about. I mean, I really am a huge fan of the company Altius, which many of you know. That's a company that's a royalty company, diversified across commodities. They just bought a lithium royalty company. So lithium is now 22% of the net asset value, and copper, and got exposure to gold and so on. But they also have a whole bunch of royalties on nutrients, potash properties up in Saskatchewan. So that's a very good way to benefit from higher potash prices.
LTS. I mean, because I think if oil is the headline risk here, fertilizer feels like the second order shock that hits with a lag and arguably even lasts longer. So do you think the markets are mispricing that second wave of inflation risk?
Oh, absolutely. No, absolutely. The market generally, I think, is mispricing the risk right now. And again, it's a matter of assessing risk and potential. It's not a prediction of what's going to happen, but I think the market is not pricing risk appropriately. And you can look at that in just the value in the price of the S&P. You look at it in the price of the VIX, the volatility index. That should be exploding upwards with what we're seeing right now, because again, when you look at risk, you might say, well, I don't think this is going to happen, but I want some protection in case it does. Well, if you want protection in case it does, isn't the VIX exactly what you buy? All right. And yet it's not exploding upwards. I think the market is significantly underpricing those tail risks.
And it also means what for your expectations with regards to the Fed?
With regards to what?
With the Federal Reserve and its ability to cut into potentially higher inflation exacerbated by oil.
Yeah, the Fed, if you go back 4 months ago when they introduced the QE, the non-QE QE, remember? The perception was that the Fed is just now, all barriers are off, and they're just, they're going to go crazy with easing. You have people talking about 3 or even 4 rate cuts this year, and so on and so on. That narrative has dramatically changed. It's dramatically changed for a couple of reasons. One is that the unemployment has not got ostensibly worse, whereas inflation remains stubborn and picking up. So just looking at the government reports, you can't deny that inflation is not under control. And if you look at the last Fed minutes that were released recently, a majority of the Federal Reserve Board, is more concerned about inflation than they are about the risk to the economy. That was before the war, of course. But they're more concerned about inflation than they are about the economy, which means the result is seen in the dot plot. The dot plots called for, where the Federal Open Market Committee members say what they expect by the end of the year. And of course, what you expect is partly based on what you want, right? These are the people setting interest rates, but they're calling for only one rate cut this year. And even more significantly, they're calling for only one rate cut next year. And if you listen to Powell, Jerome Powell, at the last press conference after the last meeting, I mean, we didn't expect him to cut rates. Nobody did, I don't think. But it was a much more hawkish commentary, I think, than one would have expected. These are all straws in the wind, but put all the straws together and they become something meaningful, something of substance. Powell said he was going to stay on until, even after his term ends, he's going to stay on until Walsh, Trump's appointee to replace him as Fed chairman, until Walsh has been approved by Congress and confirmed, thank you, and is actually, he said, sitting in my chair, but also until the DOJ, he said he will stay as a member of the Fed until the DOJ investigation of the Fed and himself is over. So now you've gone from a narrative 4 months ago where, Trump's taking over the Fed. You know, he's got one guy on, I forget his name now, who's 100% Trumper. He's getting rid of Powell. He's fighting Powell. He's fighting Cook. Oh my gosh, Trump's taking over the Fed. Now we're in a situation where he's got one guy on the Fed, and then Walsh comes in. He's got two guys. They're still a minority. So the narrative has shifted towards, wow, maybe the Fed isn't going to be quite as loose as we thought they were. But I think that narrative will shift again as the economy slows. As the economy slows, you know, there's going to be more pressure to cut rates than there is to be concerned about inflation.
Right. So you do see more cutting ahead. Adrian, as we wrap up here, given all
and QE.
And QE, so you do see more rate cuts, more QE.
Yeah.
Again, arguably bullish for gold.
Correct.
As we wrap up here, Adrian, given all of the factors that you've discussed, and granted there are a lot of variables that can change, how are you positioned right now? What are the opportunities that you're seeing?
No, that's a really good question. Look, first of all, I think it's really a good idea in a time like this, which is so volatile, because as you say, who knows what Monday morning will bring? Who knows? We just don't know. It's a good idea to have some cash so that you can act quickly to opportunities that arise. That's the first thing I say. So, you know, have some cash on the sidelines. I would definitely be looking at buying gold. If I'm underinvested, I would definitely be looking at adding to the gold stocks now. Some of them are just incredibly undervalued. And also the other commodity stocks, frankly, like copper and again, the agricultural stocks. So that's one area. And the other areas, I would look at foreign markets. Again, I said that even though the foreign markets on a relative basis have outperformed the S&P this year, you know, a lot of them are down. And so we can now take advantage of those opportunities in select foreign markets. You maybe don't want to be buying in a country that is a huge oil importer, but we can take advantage of those opportunities and look to buy. And there's some great opportunities. We're bottom-up investors, which means that we look at individual companies. We don't say, I like Switzerland. What shall I buy in Switzerland? We say, oh, here's a company. Oh, it happens to be in Switzerland. But as Warren Buffett said, I like to fish in well-stocked ponds. So there's well-stocked ponds in countries like Brazil, Singapore, Great Britain, in fact.
Even with higher energy prices and potential global slowdown?
Yeah, no, absolutely. Absolutely. Remember...
Any you can share? Any bottom-up companies that you think that have potential even in this environment that you can share?
Yeah. Well, let's see. In Britain, there's a company I like called Fever Tree. Some of you, Fever Tree drinks, they make that... they become the mixer of choice among... If you go to any high-end restaurant, I challenge you, just go to a high-end restaurant and ask the bartender what mixers he uses. The odds are bet them 50-50, he'll say Fever-Tree. That's replaced Schweppes as the mixer of choice. It's a British company that makes these things. Their ginger beer is particularly good, really good. But the catalyst here, so they've had growth. They're not a cheap company on a valuation basis, but they've had tremendous growth as they're getting into restaurants and bars and so on. But you could never find it anywhere. Even if, like me, you look for it, you couldn't find it. Now Molson Coors has taken a 10% holding in the company. They're manufacturing it in the US, so they avoid the tariffs, but equally they are distributing it in the US. You can now find Fever-Tree. I found it, and I went grocery shopping on Saturday here in Puerto Rico, and there was Fever-Tree sitting on the shelves. So you can find it now. So I think the growth is going to be potential. That's one example. And then another one I mentioned, one of my favorite companies is a little company in Singapore called Kingsmen, which is a Kingsmen Creative, and they design and manufacture all sorts of sort of entertainment things. So when Disney built the Disneyland in Shanghai, they built a lot of the rides, not the actual mechanics of a ride, but the design of a ride, like the pilot screaming at you and all that kind of good stuff.
These all sound like consumer discretionary products to me that maybe wouldn't do so well if the economies slow down, or maybe people will drink more. I don't know. It depends.
Well, alcohol is another huge subject, obviously.
No, I mean the fever pitch, because you said that's a mixer.
Yeah, but you know that people are drinking less right now. But typically, traditionally, in a recession or a downturn, alcohol sales tend to hold up well.
That's a whole other conversation. I know that younger generations are drinking less and less. Personally, I've never been a big drinker, but I do know we need to wrap it up here. So those are some of the equities you're looking at: stay in cash, exposure to gold. Final thoughts as we wrap up. But I would have to, I have my final thought, because I can see some of the viewer comments. She didn't ask him about silver, so I know that I have to then get a question in about silver, Adrian.
Look, I'm bullish on silver. There's no question about that. And there's a lot of fundamental reasons to be bullish on silver. I am not as bullish on silver as I am on gold for two main reasons. One is silver, of course, is more industrial. So in a recession, the demand will go down. But secondly, as the price of silver has moved up, the industrial users of silver do what industrial users always do when the price of a major input goes up. They look for substitution and they look for efficiencies. So you see this already with solar panels. The amount of silver in a solar panel made in China today is less than it was 2 years ago when silver was at $20 and $10. Not surprisingly. When it was $10, nobody cared about it. Nobody thought about it. At $100, you start to think, how can we make this more efficient? And the other main reason, to be honest, is on a risk-reward basis, I think gold still has a better profile than silver. If you look at extreme scenarios, economic scenarios, which would hurt silver, gold would hold up better. That doesn't mean I don't like silver. And it doesn't mean I don't think silver doesn't have higher potential. Just on a risk-reward basis, it's not as attractive. Is that
okay? That answers that. I know that that's your answer on silver, which is why I kind of saved it till the end. But because I always read the viewer comment and I appreciate them, and I know that we would get one asking your thoughts on silver. So thank you for sharing that with us. Final thoughts, Adrian, as we wrap up here.
Well, the final thought really is that people really have to look at their own financial situation to see, where they should be. As I said, the mythical 75-year-old man with 50% of his total net worth in gold perhaps shouldn't buy any more right now. But the person that's underinvested in gold and silver definitely should. So it really all depends on your own personal financial scenario and circumstances, and frankly, your risk tolerance. Some people can tolerate risk and other people can't. And if you're the type that simply cannot accept risk, and if a stock goes down 20%, your initial thought is to sell it, you shouldn't be in the sector, right? Because that's normally the wrong thing to do. So it all depends on your own personal circumstances.
Right. Okay. Well, thank you for sharing your personal insights and analysis with us. Always a pleasure. Adrian Day, thank you.
Well, thank you very much, Michelle. Good to see you.
Good to see you. And as always, a big thank you to our viewers for joining us. If you found this conversation insightful, interesting, educational, which we hope you did, all of the above, be sure to like, share, and subscribe. It really helps us grow this community. And please leave your comments, praise, whine, or just opine. We do want to hear from you. I'm Michelle Makori. I will see you next time. Until then, stay sovereign.
This is The Real Story with Michelle Makori.